Hi, welcome to the Fintech Times Presents series of webinars. Established in 2016, the Fintech Times is a global multimedia news outlet centered around the world's first leading fintech newspaper. We report on the latest and brightest ideas from around the fintech world. Firstly, I'd like to say hello to you, our audience. Thank you very much for joining us. Today, we're going to be discussing pay as you earn and buy now, pay later as part of our Paytech focus on the Fintech Times. As always, we'd love it if you could follow the conversation using the hashtag Fintech Times Paytech, and please follow us at the Fintech Times on Twitter. We have a great group of people today for the discussion. The panel is going to consider the rise of the buy now, pay later and advanced salary payments schemes, the current situation, look at regulation, and really what the future is going to look like in open finance and embedded finance. So I'm going to start off by just asking each of my panelists to give the short introduction. Morning, Alex. Perhaps you could give me a short intro of who you are and the company you're representing. Thank you.
Yeah, sure. So I'm Alex Marsh. I head up the UK business of Klarna. For those who don't know, Klarna, we're a global payments provider. We're a Swedish bank. We operate across 90 different countries around the globe. Specifically in the UK, we're very well known for our buy now, pay later products, where we support over 40 million consumers across a merchant base of just over 13,000.
Wonderful. Thank you very much for joining us, Alex. And Sarah, if you could also give us a quick introduction.
Good morning, Mark, and thank you very much for inviting me to join your panel today. My name is Sarah Williams-Gardner. I'm currently the CEO at Fintech Wales, and Fintech Wales is a members organisation representing the thriving and growing fintech scene and sector here in the Welsh Principality. Prior to that, I was one of the founding members of Starling Bank and worked there for 5 years. And I've also done some work with Fair for All Finance, which is around affordable credit and supporting that affordable credit market. So really looking forward to the discussion and really looking forward to learning.
Awesome. Thank you very much, Sarah. And last but by no means least, Richard, if you could just give us a quick introduction.
Hi, Mark. I'm Richard Brown. I'm Chief Marketing Officer at High 55 Ventures. We've just launched Hi, which is an innovative payroll platform that enables businesses to defer their payroll obligations by 8 to 12 weeks, unlocking free cash flow for the businesses, at the same time as taking over payment for their employees. So they pay the employees either daily or weekly, increasing their liquidity and their financial well-being.
Awesome. Thank you very much. Right. I've been looking forward to these sort of this session for a while now, and I'm going to start with Alex. The buying, as you kind of alluded to in your introduction, you know, Klarna actually didn't start off as a buy now, pay later provider. You actually sort of provided banking services. When did this sort of, I won't use the word, I was going to use the word phenomenon, but when did this sort of trend or the interest in the buy now, pay later sort of schemes become a reality?
Yeah, I'd say there's kind of two macro trends that feed into that. So first off, one would be, you know, stemming all the way back actually from the financial crisis of kind of 08-09, we've seen a shift in the way consumers make their payments, and that was really moving away from some traditional forms of credit cards, for example, and moving away from those forms of payment for their everyday spend towards debit. And ultimately, you know, I believe that's a good thing ultimately in terms of, you know, avoiding interest and charges for everyday spend. That trend has kind of continued since then, and actually we've seen another, that kind of macro level, big change in the way people pay over the past year from the pandemic. So I think, again, you look at 2020, you know, repayments on credit cards down 16 billion, and the shift across to debit. Now, where in that shift across to debit, there will be points in time where people need that extra flexibility. It might be because they're purchasing online and they want to essentially try before they pay and have kind of protection when they haven't necessarily know the retailer or haven't physically felt or seen the good and the protection that credit can bring there. Or it might be just for their cash flow purposes that they need to be able to spread the cost of that purchase over a period of time. And that's where I think, you know, as one of the trends that's driven buy now, pay later has been, it's come in and our products are interest-free, they're fee-free, and they give that flexibility, but in a structured way tied to a particular purchase, rather than kind of these open credit lines that came with credit cards where, you know, too often consumers end up revolving and then incurring charges and interest and actually end up paying, you know, more for the goods than they'd initially planned. So I think that's one macro trend, you know, and we've seen that kind of accelerate over the past year from the pandemic. And then the second one has clearly been that shift to e-commerce. And and the fact that, you know, more and more people are shopping online, again, accelerated significantly by the pandemic. So we, you know, stats for the UK for the past year have kind of exceeded projections for where we thought e-commerce would be in 2025. So kind of massive acceleration. And again, with that shift to e-commerce, consumers are wanting to have that protection if they don't know that retailer, and they want to have, you know, in our products, for example, you can try before you buy or try before you pay, receive the goods, decide which ones you want to keep, and actually you only have to pay for the items that you've chosen to keep without all the hassle of kind of waiting to get refunds back from the merchant where you might need that money to use on something else. So that's been a big shift. And what, you know, within that shift to e-commerce, you know, one last piece is around the change in the demographics that's driven. So, you know, typically we saw that skew to sort of millennial shopping online, Gen X are kind of 40 to 54-year-olds and above shopping bricks and mortar, and that kind of forced shift to e-commerce over the past year. You know, more of those Gen X, for example, have discovered, you know, this payment option in the checkout and thinking, well, why wouldn't I choose to have that kind of protection or flexibility versus, say, debit? And hence, for us, fastest growing age demographic over the past year has actually been Gen X, so 40 to 54-year-olds. So yeah, it's been like, I think through that, you've seen that growth then where it started with millennials to where we see now at Klarna, over, you know, 40 million UK consumers have used us.
Yeah, I think it's a really good synopsis of some of the key trends. I was going to come to Richard straight after that, because obviously, Richard, your company, as you sort of alluded to in your introduction, is around payroll solutions. But obviously, one of the things that you've started looking at is obviously advanced payments and being able to pay employees early. Has that kind of come about because of the buy now, pay later sort of schemes that have been started already, and a sort of a drive from your users to want to do that? Give us a little idea about how that sort of started out.
Well, I think that both Klarna and Hi are both trying to solve the same issue, but coming at it from a fundamentally different place, right? So one of the main drivers of financial stress in the UK is cash flow issues. And either there's two ways of solving that. Either you extend the credit line to people, or you give people access to the money they've already earned. So because we're able to offer a win-win solution for both employers and employees, our solution is offered free to employees, so there's no chance of a cycle of debt. And we also don't extend any money that hasn't already been earned. So this is about giving employees access to the money they already have. We find that in OECD countries at the moment, there's $1 trillion at any one point that is owed to employees that is wrapped up in employers' treasury departments. And we believe in returning that liquidity to the employees. It's just going to be a great boost.
It's really interesting. I was going to come to Sarah, and I was thinking about a delicate way to phrase this. From your knowledge of the traditional lending sector, I didn't want to say that you've been around for quite a while and been in the industry for a long time, but I've just said that anyway. But what I was trying to allude to is the fact of obviously being aware of lenders and the traditional lending scheme. What's your sort of take on the buy now, pay later and the advanced wages thing in that traditional lending space? Sorry, Sarah, you're on mute. We did say that one of us would do that. I was expecting it to be me, to be honest.
I think, you know, there are horses for courses here. And I think just picking up on what Richard said, this is about cash flow. And there are some people who can't get access to the traditional loans. So you know, we've got a market which is evolving, and it's evolving because people are after these products. I think all of them have a place. And I think what we're hearing here, and we're hearing from Richard, and I completely conclude or agree with it, is, you know, we're not giving people money they haven't earned. You're absolutely right. I have been in the industry for some years and spent almost 20 of those at IBM. And IBM actually used to pay you at the beginning of the month for the month you were going to work. Now that most probably is absolutely unique, but just to put that sort of fact out there. You know, what Richard's providing is, as he quite rightly says, is cash flow. And in the world that we're living, you know, many people, all of us, at some stage in our lives will need to go through credit. And we either do that through getting a traditional loan, and traditional loans are available to some people, they're not available to all. And where they're not available, you know, we're seeing the increase of high cost credit. And that's something that we really want to avoid. So the solutions that we're seeing here, I think, have their place. You know, I've been quite vocal about some of the buy now, pay later. And when I hear it explained by Alex about using it to buy a product that you're not sure whether you're going to keep, I think, you know, that puts it in a really good context. So for me, a lot of this is about communication. It's about consumer protection. I think we need to be really clear when we say there is no interest. How long is there no interest for? You know, we have seen the Woolard review, which I know we'll come on and talk about. But for me, I think all of these things have a place. They're all serving a consumer need and requirement. The big thing for me is let's communicate them really clearly so we don't encourage people to get themselves into financial difficulty. So we put things like affordability and vulnerability into that discussion. As I said, we've all needed credit. You know, the first time I got a credit card, it was a very long time ago. And I managed to rack up so much debt that, you know, it was something I had to cut up and I had to pay off those debts. So I suppose my experience comes from my own personal mismanagement of credit and the pain of what it was to get into debt. And nobody at that time explained to me what getting into debt was going to cost me. So that's my perspective here, is the clarity. And I know that everybody on this call, and I've seen huge advances, especially from Klarna, that they take that affordability and vulnerability really clearly. And maybe Alex just wants to come back on that.
Yeah, I'd really like to. I think there are a few parts of that really resonate from what you said, Sarah, with me. So I think one piece is around some of the challenges. You know, we'd say, like, why has there been that shift from, say, credit cards across to debit as a kind of primary form of payment? And a lot of it, you know, plays to the experience that Sarah's had, where the kind of challenge where you go in with the best intentions with a credit card, and, you know, there's kind of behavioural science proves that when people are often given a credit limit in a facility, it'll actually encourage them to kind of operate up to that facility. You know, you're given a £2,000 credit card, the kind of lure to go and buy up to that limit, and often, you know, with the intention to be able to repay it, but too often, you know, people aren't able to. They get into the trap of minimum payments, you know, interest charges and fees. I think one of the feedback when I sit on our consumer councils and talk to our customers, one of the pieces that they love, you know, about our products is the fact that they're using it tied to a specific single purchase. We assess for eligibility every time they use Klarna separately. It's not a facility, it's not like a limit. We'll assess them on, they're buying that jumper for £50, they want to spread the cost over 3 payments, interest free. We will assess them for that. They may be approved that time. 3 months later, they may choose to buy a different item, try to use Klarna. Potentially their circumstances have changed in terms of how they've used credit elsewhere, etc. And actually we can't approve them. So I think that real-time kind of assessing eligibility for each transaction is one part which is really key to avoid that kind of racking up unsustainable debt. So that's one piece which I think is really important. The other piece I completely agree with about the education and understanding and transparency. So again, many of these products look the same at the kind of front end. They're billed as kind of interest free. But often then consumers aren't aware of the kind of fine print that maybe it reverts to being interest bearing after a period of time, or that fees will be levied if, you know, even if they just happen to not have funds in the account on that one particular day and they haven't moved funds between accounts, they get hit with a £12 fee. And I think having absolute transparency from our products, our buy now pay later products, they are interest free and fee free, you know, forever. There isn't a reverting to an interest bearing product, for example. We don't charge fees if they miss payments. And that really gives us the incentive to make the right decision up front as to whether they should be eligible for the product or not. There isn't a kind of a benefit down the line to bring them in and then to generate income off them, revenue off them from, you know, fees and charges. But often that isn't transparent at the point of sale. Consumers aren't aware of that, kind of get drawn in by some of like the headline messages, and then, you know, don't have the right kind of protection should their circumstances change later on, which is, yeah, why we can come onto it, but why, you know, we've been very clear and vocal about supporting regulation of this sector to bring in kind of common standards across all these products.
Yeah, and I think it's a really interesting point to bring that into the generation or the people that are actively using it. There's also obviously a lot of talk in the mainstream media about it's millennials and it's young people, and I guess the people that are more mature within the financial services have an impression that, you know, people like Klarna are preying on the people that don't really understand how finance works and think that, you know, you're going to then be bashing them with fees later. I don't know if obviously if you've seen that as a trend with the sort of the, as you said in your opening sort of discussion, it did seem to be more of a younger audience that you were first appealing to. But,
yeah, so I think, yeah, that journey has changed. So like average age of our customer right now in the UK is 34. It's the same age in terms of like how, you know, the first time house buyers in the UK. So these people are able to go through like the process. You know, I've been through it. I'm sure people on the call, like the complexity and challenge of buying a home is a nightmare. It still is, whatever age you do it. But they're able to go through that process. You know, they are able to then go through a process to, you know, our average kind of order value for using our buy now, pay later products is £70 in the UK. So for them to be able to understand, you know, an interest-free and fee-free product to make payment for a £70 purchase versus, you know, buying a home, I think they're able to. And I think too often these consumers are kind of treated like infants, you know, so they're not sort of smart enough to understand this. Actually, interestingly, we in our last consumer survey, we looked at kind of understanding of credit cards. And the kind of the level of consumers who don't, you know, they understand what a credit card is, but they don't understand the absolute basics. What is the APR on their credit card should they not make, you know, the full payments on time? You know, I think it was like over a quarter of them, and I'm sure it's actually higher in reality, who didn't know what the APR was on their credit card. And that's like the most basic term of that product. And it goes back to, I think we need to find ways on all these products of explaining them in ways that resonate to consumers. And that shouldn't be age defined. It should be defined by the nature of the product that, you know, consumers understand regardless of their age.
And just coming on to that, it's interesting what you say, that many people, or where you started was possibly in the millennial market. As someone who was part of the founding team of a challenger bank, you know, there was a perception that our audience would be also in that sort of millennium market. After a very short space of time of being in the providing of the current account, we were really surprised that we had such a huge take up of customers much later on in life. And at the time that I left Starling, I think our oldest customer was just short of 90. So, you know, there is this perception in the marketplace that these digital products are used by a younger generation. I think that is wrong. I think there are people who are digitally comfortable. They might not be digitally native, but they are comfortable in that space. And it's interesting what you're saying, Alex, that you're seeing that in your market as well. It certainly wasn't something that we thought when we set out, but we have been, you know, we were proved wrong.
Yeah, I think it's really interesting. Maybe bringing Richard into this as well, because again, it's probably perceived that, you know, the only people that want, you know, daily access to their savings are younger people because they want to go and spend it and get on with it. What's your sort of take on the generational thing?
Yeah, well, less so generationally for us, but in terms of assumptions about levels of salary is something that we find really interesting. So we did some research into what level of salary you don't get caught out between payment terms in terms of a 30-day payment cycle. And a quarter of people earning over £100,000 actually reported in the last 6 months getting caught out by a large payment between 30-day periods, which could be their car's broken down or something like that. And so we find that actually giving them access to their salary early, rather than forcing them into the hands of credit card providers or even payday loaners, is just a huge boost to their employee, their emotional well-being and their financial well-being. It just increases their financial resilience as they go forward.
It's really, that's a really interesting statistic, because you wouldn't have assumed that. You would assume that someone that's earning 100 grand is, you know, for what we just discussed, a more mature, financially savvy person. How are they getting cut short, you know, at the end of the month? That's very interesting. One of the things I was going to come to Alex and just want to talk a little bit about the technology, because I think one of the things that maybe we need to do to demystify the sort of buy now, pay later and the advances, let's talk about a little bit about the tech and how it actually works. Because obviously, you know, it's not credit, you're not charging interest. So who pays? Who pays for the product, and where does the money come from, and how does it all move around?
So we should be clear. So it is credit. So I think there's been this sort of mystery. It's not credit, and ultimately it is credit. Like ultimately, you're giving people a chance to defer or delay payment or spread payment over installments. So I think we should be really clear about that. We're clear about that in terms of when you apply that it's a credit, it's just an interest-free form of credit. So I think that's super important. Then when you move to kind of how is it then interest-free or fee-free, as well in our case, and you know, often it sounds like too good to be true ultimately, and that's coming from it being essentially merchant-funded credit. So this is where the merchant, in the same way that they will pay a fee to allow their customers, for example, to use a credit card or American Express or to use PayPal, they will pay a fee to Klarna to give their customers, those who choose to use Klarna, the flexibility to defer payment or to spread payment over installments. So it's relatively straightforward. We receive that fee from the merchant. Their customers who use that payment method get the benefit of that flexibility. I think the real positive for that is that it ends up being essentially more of a level playing field for consumers. You look at, again, I know I sound like a broken record, but you look at credit cards. When I speak to people of higher wealth, they've got these amazing credit card deals with like long interest-free periods, or if it does go to interest-bearing very low APRs. Too often there are though consumers on these credit cards with like 79% APRs, even higher, who can't get access to lower cost forms of credit. So I think this acts as then a kind of level playing field essentially to enable them to access interest-free option to defer payment. And one piece I should say, which again can be like a perception gap on who uses this product, is that I completely agree with Richard. There's a really strong argument around cash flow, and increasingly people want to have that concept of like, I'll use this item over a period of time. I want to kind of marry up payments over that same time period. So that's completely valid. But there is also to that piece about buying online and wanting kind of protection or try before you buy to kind of turn your home into kind of like a changing room. There's a real convenience play there too. And that's what's attracted to different age demographics or different consumer demographics, is having that convenience of, if I do buy these jeans in 2 different colors, 2 different sizes. I was talking to a customer yesterday, Victoria. She's just returned to work. She's had from maternity leave. She's struggling to go shopping in town with a baby in a buggy, which I've tried doing with my children, is virtually impossible. Probably even harder now with kind of protections in place around COVID, etc. She doesn't want to go into stores, which would be her normal preference, even if she is able to. And actually the convenience play of being able to purchase these items in different sizes, different colors, receive them, but only have to pay at the end of 30 days for the item that she's chosen to keep, without all the hassle of waiting for refunds, paying off the credit card, then getting a refund back onto the credit card, which you have to use, is a real benefit to them. So that does, again, change the kind of the demographic, but whether age or the kind of, for example, credit score is another metric, nature of the consumers that are using Klarna.
I think that's a really interesting point, and coming to Sarah, is that, did we really ever understand how credit cards worked? As we said, the APR is a wonderful term, and I trying to explain that to my 16-year-old what an APR is was an interesting challenge, I would say. Do you think it's probably because of misunderstanding or not knowing how traditional credit worked that everyone's getting so mixed up, if you like, with these sort of other systems? Or is it just the credit card industry getting a bit scared?
I think the understanding of APR is a really good point, and I would absolutely encourage you to put in the link the YouTube video of Michael Sheen, who explains what APR is, and he tells that story in someone going into a pub and not having enough money to go through to the end of the week, and wants to borrow £75 from a friend in a pub, and he says, that's okay, pay me back next week and buy me a pint. And that concept says, okay, well, actually that's absolutely worth it. So the person who takes that credit at that time says that has value. If you actually calculate what that costs to borrow, what equates to about £4 over 7 days, the interest rate, the APR in this case, would be 1,614%. So I think there is an element that says, and it's a brilliant piece of, it's a less than a minute on YouTube. So it's a really great way of explaining it to people. And to your point, do people understand? Well, one, they don't know their APR rate. Alex has verified that in some of the consumer research that I think they've conducted at Klarna. And if you use your credit card very sensibly, you are getting 30 days interest-free credit if you can afford to pay it off every month. And some people quite understandably use it in that sense, and it's very much helping their cash flow, but they know that they're in a position whereby they are actually paying it off. I think when we look at this and said not being a generational issue, it's just the clarity of the communication in my world. Is this going to change the credit card Well, I believe, and Alex will be able to answer me, you've brought a credit card into the marketplace. So obviously you see value in that as well. So maybe Alex can fill in that space.
Yeah, maybe just before Alex does that, I wanted to get a little bit of reaction from Richard on staying on the technology theme. Just because obviously we've talked a lot about the lending, and I'm saying buy now, pay later is lending. Obviously, advanced salary, that's not lending at all, is it?
No.
So how does that work, and who pays? Because you were saying obviously it's a great example for the employer and a great example for the consumer. So where does the money go in that situation?
Yeah, so employers pay a small per employee per month fee in order to access the funding for both their deferral of payment and also for us to take over their payroll. It's really interesting, Sarah, hearing you talk about an APR of £70 and buy me a pint. We actually find that's something that's sort of relatively very, very relative to our industry, actually, where a lot of early wage access providers are offering early wage access, but at a small per transaction fee. And that APR often turns out to be quite large, depending on when you take the salary advance in the month, which is why we've come in from a completely different angle. We're looking to provide a benefit to the employer. So the employer pays for the entire benefit. It's part of their employee wellbeing process, but it's free to the employee at every stage.
Okay, that's kind of
I think, Mark, just coming back on the technology point, and one of the things that we've seen a lot of now is notification. We are using the fact that people are banking more digitally. They're interacting with their phone, with whether it's with their credit card or whether it's with their current account provider. So we are seeing much more on the notification side, and I think to give the credit card companies their dues, they are also notifying people of when the payments are due. I don't think they are preying on people as much to ensure that that they can charge those fees for late payments. So I think when we look at technology here can help where the provider of the credit is not aiming at those, it doesn't have those intents of overcharging. They can actually notify them to say, you've got 2-3 days to pay your minimum amount, or to pay, and what will that cost you? So I think there is a lot of advancement that technology has been able to bring in that space as well.
Absolutely. So coming to Alex to answer the question about credit cards, are you going to get rid of all credit cards? It also links nicely into my regulation thing, because obviously credit cards are regulated very differently to buy now, pay later schemes. So let's answer the question first.
Yeah. So Sarah, so we don't offer a credit card, just to be super clear. So we have like a card form of our buy now, pay later products, but it's the same premise essentially, is like linked through essentially to debit, but having the flexibility to spread the cost, either defer for 30 days or over 3 payments. So it's not a kind of credit card. It doesn't revert to kind of revolving facility with interest bearing, etc. And linked to credit cards, you go back to the kind of the business model, and ultimately, they're generating, over £6 billion worth in the UK alone of kind of interest and fees last year from consumers. And, a lot of what we're trying to do, our kind of mission is to return that back to consumers. Ultimately, that's what we believe through, our buy now, pay later products for specific purchases and, kind of transactions that can be returned back. So far last year, we saved just over £76 million worth of interest for consumers through using these products. So there's a lot of kind of mileage there where we believe we can bring more value back. And you look at the credit card model, it still plays to ultimately a transfer of wealth from those on kind of high incomes who are benefiting from, the ability to repay in the period of time and all the loyalty points and air miles. But ultimately, it's easy to ignore that is coming from consumers who are making purchases within a credit limit that are unable to pay off within that minimum, that period of time, end up with, a balance that just keeps running and interest and fees are applied to it. And that is essentially funding the benefit for others. We believe a merchant funded model, as a sort of parallel to an employer funded model in Richard's world is a better and fairer model. Now, when you move to regulation, we're very clear that actually, there's 3 parts of it, I'd say, which are super important in terms of, regulation. And Sarah's made the point, very strongly, which I agree with completely. The first off is around kind of education and transparency up front. Are people clear about the nature of the product? Are they aware? Are they choosing to use that product? Do they understand the key terms of that product? Completely support that. You know, we, as I said before, we present up those terms every single time they use our product, unlike, for example, a credit card where you might get that 50-page booklet once a year full of T's and C's and font size, 6, that basically gets lobbed in the bin and you don't read, hence why they don't know, their APR or their payment terms. So we present that every time. So completely agree with that. I think, is there more that can happen across the whole sector to be more kind of prescriptive or more clear on what has to be included in there? I think yes, you can, whether that's fees or other charges that they may face, or the consequences if they miss payments. I think transparency, completely agree with. The next one for us is around eligibility. Fundamental is making sure these products are offered responsibly to the right people who can afford to make payments on these. And again, we assess, as I've touched on briefly, consumers every time they use it, and that does lead to kind of difficult times where a consumer might be eligible once and then not the next time. If they do, for example, miss a payment with us, they can't use us. Their account is essentially locked or frozen, so that they would need to make payment to use us again. So you can't build up that balance. They would never pay more than the price of the original purchase that they made, because we're not applying interest or fees. And we can then work with them, for example, with payment holidays or payment plans to try and support them to pay that balance off. And then the last piece, which I think is really important with the parallel to sort of credit cards, is around protections from harm, because there will be situations where a consumer's circumstances change from that. They understand the terms, they meet the eligibility requirements, but unfortunately their situation changes. And that comes through to rights for consumers if they have complaints. And people will be well aware, with regulated credit, the right to refer to the ombudsman. We've been very supportive of that, that premise and giving that kind of right. There's probably work that needs to happen at the ombudsman to improve some of their processes. But ultimately, we support that right to have a kind of independent view on your complaint and how it's been handled. And we've been working with the ombudsman to look at an ability to join them on a voluntary basis. But regulation can be a route, hopefully, to accelerate that. Another area would be things like Section 75 protection. And again, that's why many consumers are using us when they're purchasing online, is to, versus debit, is to have that protection. And we put in place our own buyer's protection policy. But again, that's where regulation, I think, can support in terms of giving rights to consumers, regardless of which payment method or credit payment method they choose in the checkout. So I think there's real kind of positives there where regulation can support. And we've been very vocal in our support of regulation to have those kind of standards across all. We already offer regulated credit products, so a longer term, for example, over 12-month interest-free credit products in the UK. So we're very comfortable and have the kind of processes to support on regulated credit. So it's kind of in our DNA already. And that isn't true across all providers in the BNPL space. So I think there will be, benefits from regulation in terms of raising those standards and how customers are treated, regardless of the provider or the product that they choose.
I think that's kind of the really interesting point, is that obviously, yourselves and Klarna very much above board and running correctly. The problem is obviously what your success has bred is a lot of other entrants into the same field, which are perhaps not playing with the same rule book. And that's, I guess, an area where regulation can come in to actually make sure everyone's doing it responsibly.
Yeah, I think one of the things which has been very clear to us is, so we launched in the UK. So we launched originally in 2005 in Stockholm, Sweden, where our kind of headquarters are based, for example. We launched in the UK in 2014, and that came off the bat then already of nearly 10 years of kind of developing and honing these products and putting in place really good kind of support for customers. We've then built that up over the past 7 years. Kind of very proud of that, but we are always learning. Look, we're not perfect. We acknowledge that. We've made improvements. We're constantly learning and trying to respond. And one of the benefits of the technology that we use and the kind of empowerment that we give to consumers through our app is that we can iterate and improve very quickly. So I think that's been part of that journey. Now, when you look then at the kind of the 2 or 3 years ago, we were one of the only providers where we were, for example, assessing consumers whether they're eligible. It was very easy to kind of make that decision. I think fast forward a few years on, there are many more providers. The products can look very similar in the checkout in terms of the headline description. They might not all operate to the same standards, but equally there is a challenge where, again, I believe regulation can support, which is around having that visibility across all these products for us to make the best decisions to support consumers for eligibility, but also for consumers both to benefit in their credit score if they are repaying, because often people get credit cards purely to try and drive a credit score so they can get a mortgage, which is kind of bonkers. So help them build up the score, but equally if they do miss a payment with Klarna or another provider, that then they're protected from then just choosing another payment option or BNPL provider and make that purchase regardless, and then build up inadvertently debt that they can't repay. So I think there's real kind of positives that can come from regulation. It just need to ensure that regulation is proportionate to the fact that these are interest-free and fee-free products and short-term, structured in their repayment, but also look at the outcomes. Ultimately, we have much lower default rates than credit cards. We have much lower complaint levels than credit cards. And we need to make sure that in building that regulation, that those kind of outcomes are taken into account so that you can drive competition and innovation, because ultimately that's in the best interest of consumers.
Absolutely, I'll agree with that, Alex. I was going to come to Richard as well, because regulation is obviously an interesting topic. Not myself personally, but a lot of people have likened what you're offering to payday loans. And obviously there's been a lot of talk about payday loans, and we know that that is a very different product because that is a credit-based product. What sort of regulation would you welcome to sort of support your sort of business and make sure that you're actually correctly communicating and people are correctly understanding what your offer is?
Yeah, absolutely. Well, firstly, to clarify, we provide salary access, not salary advance. So we're at no stage debt for the employee. We do not charge the employee, but there's no chance of being tapped into a cycle or revolving credit facility. We're fundamentally a B2B product. So what we basically do is we don't do any funding ourselves either. We facilitate funding between employers and separate funders. All of our funders are fully regulated under the FCA and have their own eligibility criteria for who can come onto the platform. We merely facilitate that relationship. So obviously there's no regulation within the platform space. If there was to become any, we would welcome it and we would look to work with the regulators, but we really want to make sure that whatever we're offering fundamentally benefits the employee, the end user, as much as it possibly can. We're taking our ESG credentials really seriously as a business. We're a registered social enterprise in the UK. The heart of it is the employee well-being story and making sure that there's no issues relating to them.
Yeah, and I think that's something that I wanted you just to comment on, because again, I myself phrased you as an advanced salary, and it's kind of like some of the terminology that we use can directly affect public opinion on what the actual service is. So it's good to hear that clarified a little bit. We could probably carry on this conversation forever, but I was just going to go to Sarah just to finalise on that sort of conversation about the regulation. What's your sort of viewpoint on that? And then we'll do a little bit of summing up after that, I think.
I think when we talk about the regulation, it's clarity. We've got two people eloquently describing the functionality and the facility that they're both offering, and there is great scope here to misunderstand. And I'll just say, I thought Klarna was going to bring a credit card to the market. So I apologise for that, Alex, and thank you. I did say I wanted to come here and learn, but that's because we read things often in tweets and in headlines. And so I think the regulation really has to focus on the communication and the protection of the consumer. And to Alex's point, with digital and with the ability that most people are doing this in the palm of their hand through their smartphone device, there is that opportunity to communicate that at all times. So for me, the regulation just needs to put consumers at the heart. And clearly we've got two organisations here who are putting the consumers and the end users at heart and are doing the right things. But there are other people coming into the market, and the market is growing. We're now seeing other new entrants, not just in what we would say the sort of e-commerce space, but we're seeing a lot of new entrants, especially down here in Wales, in the travel provision. So, the idea that you're going to buy flights and lay them away for later. So that whole layaway concept, which is most probably been around for a very long time. Many people used to put a deposit down on something and then pay it off and get it at the end. So I think the regulators just need to be very clear on what's being offered and encourage the providers to do that in a very clear and concise, and to Alex's point, not in type 6 font and not in lengthy books, but in a way that is easily digestible.
Wonderful. Thank you very much for that, Sarah. As I said, what we're going to do now is kind of get a bit of summing up. So what I'd like to do, and it's always very difficult in current times with pandemics and various other things, what's the future going to look like, Alex? Where is the market going, and what's happening with the industry? Maybe not focusing too much on regulation, because I think we've done that one.
Yeah. I mean, one thing, like I really like Richard's business model actually, and I think, you know, like linked to our model, I think more and more, and to the point Sarah's made, more and more consumers will be using, you know, connected apps to have a real-time view of their finances, whether that's, you know, their ability to spend because they can see the income that they've earned it, and they, you know, they should have those funds, but then equally the kind of transparency of the costs they have coming ahead, whether that's through having, you know, spread the cost over time to help them manage their cash flows, or other kind of committed spends they have in their everyday spending. So I think that real-time visibility, I think, is, you know, something which I think is really exciting. And I think, you know, the much famed kind of topic of open banking is an exciting route into that kind of real-time view for consumers in one place. And I'm really hopeful that, you know, potentially post Brexit, there is an opportunity for the UK to maybe advance some of those areas within the UK that maybe was more challenging to progress given the kind of the nature of the EU. You know, I was a fond supporter of the EU, but you know, there is an opportunity there to you know, potentially progress areas like open banking quickly. And I think open banking is an exciting one. You know, one for me, which has been a real challenge for us around eligibility assessments, as I touched on, is around that visibility, and it's true for all lenders. But also it's about having, you know, with the credit data we use today with the credit reference agencies, often, you know, it's 6 weeks out of date, there's different information on different bureaus. And again, I think open banking, once we get to a point where consumers feel confident to trust to share their data or for specific uses, can have a benefit, for example, in our sector too, in terms of having a real-time insight into consumers' circumstances to make the best possible decisions around eligibility that will support them in the best possible way in terms of, you know, for example, the payment methods they can use. So that for me is an exciting one, which I'm really hopeful can progress over the coming years.
Excellent, interesting. And maybe coming to you, Richard, I was just thinking as Alex was talking there, you know, it's obviously, you know, whether it's too much Big Brother or not, but an access for Klarna to be able to see how much salary an employer's already earned but not taken would make the credit scoring methodology a lot easier, wouldn't it? And so there's an interesting there, and open banking as well. But I won't put words in your mouth. Tell me what you think the future is going to look like.
You've actually, Alex, really interestingly just described one of our main products. So we have an app that provides real-time payroll information. So employees can see exactly how much net pay they've earned up to that point, including all their deductions for tax, national insurance, student loans, whatever it may be. And then as part of our collaboration with MasterCard, we have that released on a card that the credit limit increases daily in line with their earnings. So this is not a credit card there, but it's not a credit facility. It's giving them access to the money already earned in real time. One of the things, to answer the main question, Mark, was where I think we're going in the future. And I think especially in this space, you'll start to see more and more employees asking, why am I getting paid 30 days in arrears? Why do I have to wait? Why do I essentially giving my employer a 30-day interest-free loan for my own labor? That doesn't make any sense. We're seeing a change in the way that employees see well-being programs and company benefits away from things like ping pong tables and free lunches and towards real financial tools that can help them in their real life, right? And we think that liquidity and giving them access to what's theirs is one of those things. So that's something that we're hopeful for the future, and we're looking forward to helping build it.
Wonderful. Thank you very much, Richard. And Sarah, your sort of final thoughts, other than obviously every fintech moving to Wales, what's your sort of view of the future?
Yeah, please. I'd love these two organisations to have a presence in Wales. We'd welcome you with open arms. I think we've touched on it. I think open banking has the opportunity to put control into the consumer's hands. And so when maybe they are declined for a product, they will understand why, and they will understand that their affordability and eligibility is being put at the heart of those discussions. You know, to Richard's point, why shouldn't people be paid what they have earned? I think for me, there's a huge opportunity there in open banking, just to give people more information to make a more informed choice and to be on top of their finances. I mean, Starling set out to digitize the current account to help people manage their money, and open banking and open finance and open data has the ability to go even further than that. I think the one thing for me that I'd like to see, and we have seen a fair amount of it in the pandemic, and that is a little bit more focus on saving. So the idea that you do put things away for a rainy day, and that we have those saving pots. And I think Alex mentioned it earlier, there's been a significant paying off of credit cards over the last 12 to 15 months through the pandemic. And so people are starting to get that little bit of a buffer. So for me, I think open banking also gives people the opportunity, when they've got that whole visibility of what they've earned, what they're needing to get on some form of credit, the opportunity to also see what they're saving. And that for me would be the nirvana, is that you've got all of everything in one place and not having to manage complicated spreadsheets, but that the whole of the financial industry is working together for the consumer's benefit.
Wonderful. A vision of a utopian future to end us on. I'd love to have spoken with you all for hours and hours more and really unpick everything else, but it's been an absolute pleasure speaking to all of you. So Alex, Richard, Sarah, thank you all for your time and attending and talking to us today at the FinTech Times.
Thank you, Mark.
Thank you, Mark.
Thank you very much.